there are two key concerns. Fears US tariff policy may push up prices, slowing growth, and the US government is having a hard time selling debt. The latter led to a 1.6% decline on the S&P 500 on Wall Street, the biggest fall in a month. Weak investor demand for US bonds overnight, which, if sustained, may push up long-term interest rates.
That comes down to concerns about whether or not the US will be able to pay its debts. Now, that sounds pretty ordinary. They'll pay the debts one way or the other. They can print their own money. But that money printing is exactly why a lot of potential bond buyers don't want to take the cheap price on offer. They're looking for more yield. They're not getting it. And that's concerning investors in both the bond and the equity markets.
Last week, Moody's stripped the US of its AAA credit rating because of rising US debt over a decade, with fears it'll grow further. Here, the Australian share market didn't fall as hard as the US, the ASX 200 down 0.5%, with tech stocks performing the worst. The banks fell. The sector, though, is offering financial assistance and relief to customers impacted by the New South Wales floods. Insurance Australia Group rose after the ACCC waved through its takeover of smaller Queensland-based RACQ. And after the markets closed, Rio Tinto's CEO, Jacob Stausholm, announced he would step down later this year. Gold stocks rose as the price of bullion climbed 0.5% on this time yesterday. The opposite is true of the oil price, with Brent crude back below $65 a barrel. The Australian dollar is only a touch weaker against the US and is also down across the other major global currencies except against the New Zealand dollar. And in cryptocurrencies, Bitcoin has hit another record, surging above $111,000 for the first time. It's now up around 50% since the April low. The latest surge coming as Donald Trump prepares to meet holders of his Trump meme coin later this week.
In his first term, he has been very focused on deregulation, which has been positive for the likes of cryptocurrencies. And more so for this term, there is a concern, or there is more expectations of executive orders, policies, which may actually further open up the adoption of cryptocurrency.
Bitcoin is unregulated. Wesfarmers CEO Rob Scott says Tuesday's interest rate cut is a welcome relief for customers, but that it will take some time to flow through to a change in spending and investment. The diversified company, which in addition to its chemicals and energy businesses owns these retailers, acknowledged that many Australian households are struggling.
Many lower income households are still doing it tough, some making deliberate choices to put fewer items in the basket. There are other customer cohorts, particularly those that would own their home without mortgage stress, that are continuing to spend. And we see these trends across our retail businesses.
Despite the growth it's seen in e-commerce, Mr Scott says stores will represent the majority of retail sales for the foreseeable future. Falling interest rates and tight supply have seen economists at HSBC revise up their expectations for national house price growth next year. Affordability constraints will likely see smaller cities post stronger rises than larger ones. This week's rate cut, though, will increase how much money potential home buyers can borrow. Researchers at CanStar say a single person earning the average full-time wage of just over $103,000 should be able to borrow $12,000 more, a couple $23,000. Optus says it still has work to do to rebuild trust following a 2022 cyber attack, which is still the subject of an ongoing regulatory investigation. It comes as the company posted a 55% rise in earnings before interest and tax for the full year, as it added nearly 240,000 customers to its mobile base. CEO Stephen Rue says the results demonstrates that it is on the right path and making solid progress. Optus is owned by Singapore-based Singtel, which said while US tariffs have no direct impact on the company, the conflict could affect it indirectly through softer consumer and business sentiment. And Australia's two biggest cities have missed out on the top spots of the 2025 Oxford Economics Global City Index. They went to New York, London and Paris, following analysis of categories like economics, human capital, quality of life, environment and governance. But Melbourne did come in at number 6, thanks to its high-quality universities and cultural drawcard as a major sporting hub. Sydney one spot behind at number 7, with the report touting its high foreign-born population and attraction as a business centre, Janice, but both cities weighed down by high housing costs.